All right, everyone. Bismillahirrahmanirrahim. Assalamu alaikum, everyone. My name is Yasir Yamin, and I welcome you all in this session. My friends, in today's session, we'll be doing one very important question which has just been published for June 2024 SBR mock exam. Now, although I went through the mock, for some of the parts, I think, those were not very much technical. But I mean, this is one question that I think is very important from a wholesome perspective. First of all, this is a type of a question in which many accounting standards have been tested. So since many accounting standards have been tested, you get a chance with me to revise those and see if you are in the position to attempt such past paper, attempt such paper if this kind of paper comes into your examination. And plus I think what somewhere or there, somewhere or the other, this question also tests some part of what you can call current issue. So although this type of a question I did approximately 2 years back in 2022, some part of this question which ACCA provides in June 2024 mock, I did it as a current issue in 2022, which is roughly 2 years back when we are doing this session. But still, it's very much important. I think if this comes into your exam, you should be well prepared, to attempt such a question. So we'll start right away. Now, as we see this question, this is question number 3 of your exam, by the way, mock exam. Examiner says Jarid company prepares financial statements in accordance with IFRS accounting standards. So that's a plus part. They follow IFRS. The financial year end is 31st of March 20x3. Now, whenever you go into your exam, I have time and again repeated this. Please follow the format of looking at a question, follow the same pattern as I do. Most of the students, what they do is they start opening the requirements, they start opening the exhibits right away. You won't get, a better understanding until and unless you read the background first. So for example, from this background, I just got to know that my accounting year end is 31st of March 20x3, which gives me a starting point to memorize everything. So 31st March x3, I need to memorize. This is my accounting year end. And that means 1st April 20x2 is the year start. Then it says the following exhibits on the left-hand side of the screen provide information which is relevant to the question. Now, you have been provided with 2 exhibits, and these 2 exhibits relates to the following. The first exhibit relates to a server contract. We all understand what a server is. Eh? Server is like an an IT server. Yeah, it's a hardware equipment which is used as a channel for communication. Yeah. So it's a server contract which explains a contract that Jarid company entered into with Serveco on 1st April 2x2 to install a server. So the contract was initiated on 1st April x2 and the contract required Serveco to install a server for Jarid company, and we are Jarid company. All right. Let's move on. The next part is a more, a more interesting part for everyone, and that is about cryptocurrencies. This describes the purchase of cryptocurrencies by Jarid company on 1st of January 20x3, so just 3 months before the year end, and how directors are considering measuring cryptocurrency into their financial statements. So again, this is relevant. This information should be used to answer the requirements. Now, what I would do next is first go on to the requirement. Now, I understand that this is a 25-mark question, and these 25 marks have been, segregated into 3 requirements. I'll just read the first requirement first because that relates to exhibit number 1. It says that using exhibit number 1, please note down that only this requirement relates to exhibit number 1. The other requirements do not relate to exhibit number 1. It says using exhibit number 1, first explain in accordance with IFRS 16 leases why the server contract contains a lease. Can anyone tell me what portion of IFRS 16 is being tested here? You need to explain, whenever explain requirement comes, this only pertains to the, to the text of the accounting standard. Yeah. So you need to explain what IFRS 16 is. And you need to identify, you need to explain why the server contains a lease. And Hadia rightfully pointed out, sir, that this is for sure the topic of identifying a lease. Do any one of you remember what were the requirements when we were following embedded leases or identifying a lease? What were the four thresholds that we identified while reading the accounting standard? What were the four characteristics which must be present so that any contract can be termed as lease? We'll start one by one. Any one point from anyone. A lease should contain at least four characteristics. At least. There must be a right to control. There must be a right to control. And that right to control was further segregated, was actually explained with two headings. Yeah. So there was right to control, and right to control was established when there was a right to substantial economic benefit present, and there was right to direct use. Now, Tala is talking about substantial benefits to lessee and so on and so forth. There was no such requirements, by the way. So you need to, go with the wordings of IFRS 16. IFRS 16 started with the point that the customer or the lessee, so-called lessee, the customer will have right to control, and right to control comes with two characteristics. You have the right to, substantial economic benefits and the right to direct use. Does any one of you remember right to direct use was explained with two words? What were the two words that explained what right to direct use was? What was right to direct use? So an entity had right to direct use when it controlled how and for what purpose the asset is supposed to be used. So how and what were the two keywords that you had to remember. And now I assess how many people are actually well prepared for the exam. Then the second requirement was an identified asset, or the third requirement, I may say, was an identified asset. An identified asset must be explicitly mentioned into the contract, right? And even if the supplier, or so-called the lessor, has substantial rights to replace the assets, then it's not a lease. Yeah. If the replacement rights are not substantive, then only we can call it a lease. Remember, we discussed it while studying IFRS 16. And then there was, a consideration, measurement period, and so on and so forth, the period of use. Absolutely correct. Right? So you need to remember what IFRS 16 said. But having said that, there is another requirement attached to requirement number A, which is you need to explain with calculations how to measure the carrying amount of right to use asset and the corresponding lease liability in the financial statements of Jarid company as at 31st March 20x3. So you need to also, advise or explain how to measure RUA and lease liability. Now, we do remember how to measure our right to use asset and lease liability. So lease liability primarily was measured at the present value of future lease payments. But if there were supposed to be any termination payments or any exercise price on bargain purchase options or any guaranteed residual value, that was all made up part of the liability. And when you talked about right to use asset, so right to use asset was principally the lease liability, but you had to capitalize any directly attributable cost or any compulsory disposal cost. You always had to, and any down payments, you always had to capitalize those. Do you guys remember or not? Now, this is a quick revision of what we studied under IFRS 16. Make sense? So now we know that these requirements which solely pertain to IFRS 16 are of 9 marks. So now we can just close the requirement maybe and then go to the exhibit. Let's see what the exhibit has to say. Yeah. So it says on 1st April 20x2, remember this is the year start. So at the start of the first year, Jarid company entered into a 5-year contract with Serveco for digital services. So, I mean, Tala, if you look at it, it seems that Jared company entered into an agreement with Serveco for digital services. So at once it looks like a service contract. Now we need to see if it's really a service contract or a lease contract. Now it says under the agreement, Serveco installed a hardware-based server, a physical device with which manages access in a computer network at Jared Company's head office for the duration of the contract. So basically, Serveco is the supplier who provided a particular hardware-based server, and the Serveco placed this hardware-based server at the head office of Jared Company. It says that the server is explicitly identified in the contract, and Serveco company can only change the server if it stops working. Do you get any hints from this line? The server is explicitly identified and Serveco can only change the server if it stops working. What hints does this line give you? Why would you say that this is according to IFRS 16 a lease contract? Because here because here the contract explicitly mentions the asset. That means it is an identified asset in the contract. And whenever there is an identified asset in the contract, it hints towards a lease contract. And even you can see that Serveco company can only change the server if it stops working. If it does not malfunction, if everything's working fine, then Serveco company does not have the right to replace the asset. And it means that replacement rights are not substantive. And if replacement rights are not substantive, then this means it is a lease contract, not a service contract. Make sense? As we move on, it says that Jared company controls the data which is stored on the server and has integrated the server into its operation. So likewise, it's not very easy to replace it because, Jared company has fully integrated this hardware-based server into their systems, into their operations. So you cannot just take away the server whenever you want. Nobody cares if you're Serveco or whatever, right? So it says that Serveco maintains the server and provides data backup and software upgrades. Very good, as it should be. So Serveco company has the responsibility to maintain the server as it may be required and may provide data backup or software upgrades as they eventually come. But Serveco company cannot determine how the server is used during the term of the contract, nor it can decide whether to modify the server or use it for another purpose. So Serveco company, which is our supplier, does not have the right to decide how to use this server or for what purpose to use this server. If our supplier does not have the right to decide for what purpose and how the asset is going to be used, then this means that Jared company has the right to direct the use. I mean, we have the right to direct the use. I mean, I'll repeat it again. Under IFRS 16, any contract will be termed as a lease contract if if 4 characteristics can be identified in that contract. First of all, the customer, which is the lessee, for simplicity, the customer obtains the right to substantial economic benefit. Here you can see that it says that Serveco company cannot decide how the server is used, and furthermore, Jared company has control over the data. It has fully integrated the server into its operations, and that means during the concurrence of this contract, during the period of this contract, Jared company has the right to substantial economic benefit. Then the second condition was that customer, that means lessee, has the right to direct use. Right to direct use means that the customer can decide that how and for what purpose the asset is going to be utilized. Now here, although Surveyco company provides the maintenance or provides the data backup and provides the software updates, but it does not have the power to control how and for what purpose the server is going to be used. If Surveyco company does not have that right, then certainly it means that Jarid company has the right. The second condition is also met. The third condition was that there must be an identified asset. An identified asset, should be explicitly mentioned in the contract, and thus replacement rights of the supplier should not be substantive. We earlier saw that the server is explicitly identified in the contract, and Surveyco company cannot change the software until and unless there is a malfunction. So the third tick is also met. And fourth is obviously, period of use and consideration. All of this we can see in the contract. So can we conclude that this is a lease contract and nothing else? Can we do that? I mean, for sure, it can be easily concluded that this is a lease contract. But you see, Tala, what's more important for you is you do not only need to identify if it's a lease contract or a service contract, but you also need to explain it. Why I have repeated the same things twice and why I'm explaining in detail, because you need to explain through which point you see that IFRS 16 should be implemented. Make sense? So please make sure that you draft a perfect answer for this. Then as we move forward, let's see. Remember, we also had a requirement. If we go back to the requirement, the second requirement said you had to explain with calculations how to measure the carrying amount of RUA and the corresponding lease liability for the purpose of Jarid Company's financial statements. So as I see, the paragraphs to come relates to the measurement side of leases. So please help me out here. It says that there are 5 annual payments to be paid under the contract of 1.05 million in advance beginning 1st April 20x2. Now here I identify two things. First, the lease rental is going to be 1.05 million and we are going to pay 5 rentals of 1.05, but the lease rentals begin from now. If the lease rentals begin from now, the first lease rental would be paid on 1st April 20x2. The first lease rental would be paid on 1st April 20x2. And that is termed as the first payment, which is going to be paid at the commencement of the lease of 1.05 million will be termed as what? As what, guys? What do you call the first payment being made on the first date? You call it a down payment. Yeah. So it's purely a principal repayment, nothing else. Make sense? So technically you are paying 1.05 million today. And again, after this 1.05 million, you are going to pay 4 future lease payments of 1.05 million each. Do you all agree with this? There are in total, I can open a spreadsheet for you. So in total, there is year 0. Yeah, year 0. Then there is year 1. Then there is year 2. Then there is year 3. Then there is year 4. And then there is year 5. So there are basically 5 years. The first lease rental you are going to pay now. So 1050 now. And then you are going to pay 1050 at the start of each respective year. So these becomes 5 payments in total. Understood? Makes sense? And somebody said the first payment is not going to be included in the lease liability. Isn't that common sense? You are not going to include 1050 in your lease liability. Why? Because that has already been paid at the commencement of the lease. So if some cash flow is being paid at the commencement of the lease, why would you include it in your liability? It's already paid. Makes sense? So only 4 future lease payments will become part of your lease liability, right? It says that Jarid company will receive a cashback of 525,000 on the first anniversary of the contract. Can anybody explain me this cashback of 525,000? What is this? After 1 year of the lease, You, from the lessor or the supplier, you will get a cash back of 525. You will get a cash back of 525. What is cashback? Did we study about cashback in our classes? What is cashback? I mean, guys, you don't need to worry. Use common sense. I mean, what examiner is basically trying to say. You see, we just had to pay 1050 after 1 year. That is on 1st April 20x3. We had to pay another lease rental, which was 1050. Do you all agree? Do you all agree? Lessor is saying that in the first lease, you will get a cash back of 525, which is half of the lease rental itself. Then it's common sense. You see, Rohit, it won't happen in a manner that we first go to our lessor, pay them 1050, and then our supplier gives us 525. It's not going to happen like that. Use your common sense. What basically the lease agreement implies, or what your examiner is trying to say is, the first year's lease rental is not 1050, rather it's 525 only. It's not residual value. It's being paid after year one. It cannot be residual value, Zishan. How can it be residual value if it's paid on year one? So, if you get confused in such an easy thing in your exam, this is a problem. I mean, think about it. Your examiner is just playing with you guys. The lease agreement in itself plays with you. They could have, simply said that the first rental year zero will be paid 1050. The second rental, which is to be paid on 1st April 20x3, will be 525. But it was not written like that. To make the lease more attractive, it just sounded like that you will get a cashback of 525. I mean, it's a cashback. These are not other incentives. This is purely a cashback. So pure cashback means that although you had to pay 1050 initially, but since you will be getting a cashback, you will be offsetting this from your lease rental and just paying 525 in year one. Doesn't that make sense? For everyone, is this okay? So if I were to conclude, in year one, you pay 525, in year two, you pay 1050, in year three, you pay 1050, in year four, you pay 1050. These are the net future lease payments. Do you all agree? I just want a confirmation. Do you all agree? Make sense? Does everybody understand this? Very good. So your examiner says Jared company will receive a cash back of 525,000 on the first anniversary of the contract. Deal done. Then it says that there were direct legal costs of $100,000 paid by Jared company. The fair value of the server is $5 million on 1st April X2, and the interest rate implicit in the lease in the contract is 5% per annum. First of all, what do we do with this $100,000 paid as legal cost? What is this? What do we do with this? Guys, what do we do with this 100,000? We capitalize it. Excellent. Now this 100,000 solely pertains to RUA, not the lease liability. It has nothing to do with the lease liability. Obviously, this has just been paid. How can it be part of liability if it has just been paid? Make sense? And the interest rate implicit in the lease is 5%. So if the interest rate implicit in the lease is 5%, we can use the same 5% for discounting as well. So for example, if I were to ask you, what should be your lease liability? What should be your lease liability? I mean, lease liability is the present value of future lease payments. Yeah. Now, in order to calculate the present value of future lease payments, you need to perform discounting. And that discounting will be done at the rate of 5%. Make sense? So if I were to discount this, the formula would be 1 divided by 1 plus 0.05, which is just the formula of discount factor raised to the power 1, which is simply divided by 1.05, 1 divided by 1.05. Then you can follow on this in year 2. In year 2, the year is going to be not 1, 2. Then in year 3 and year 4, in year 3, the discount year is going to be 3. in year 4, the discount year is going to be 4. Make sense? You can just try and multiply the relevant cash flows. And here you go. If you sum all of this up, this equals, if I may convert it into numbers which are more understandable for you, the present value of the lease liability is 3.22 million or 3223 in thousands. This is your lease liability. Now, is this understandable by everyone? Anything difficult till here? If everyone can confirm, then I can move ahead. Yeah. Now, let me ask you, Roxanne, if you can tell me how to measure the right to use asset. How to measure the right to use asset? So, right to use asset was basically measured initially at the lease liability. Yeah. So, this is 3223, present value of future cash flows. I just don't like poor formatting. I don't know why, but this is just my habit. Yeah. 3223. Should we add up anything here? At least two things need to be added up. At least two things I need to add up, and I want your support. So one, add up any down payment, initial payments that is not part of your liability but has been paid to take control over the asset. So that is 1050. I won't calculate present value of 1050 because that was the amount paid right now. And then you need to add up, very good, the directly attributable legal cost. And that was 100,000. So 100. And my friends, what is the value of your right to use asset now? If you sum this up, the value of your right to use asset is now 4.37 million. Make sense? If anyone was to say that, sir, how do we make an accounting entry for this? So RUA will be debited with the value of 4.37 million. Lease liability will be credited with the value of, what was the value, by the way? I don't remember. 3.22? Yeah. Oh, no. 3.22. And then what you are left with? You are left with cash, which is the difference of these two. Make sense? 1.15. 1.15 is made up of two things. 1.15 or 1150 is made up of two things. 1050 was the initial rent, initial down payment, plus 100,000, 100K was paid as legal cost, and all of this was in cash. And here you go with the accounting entry. Does everybody understand? Any issues with this? Is it okay for everyone? Give me a confirmation if you understand this. Well, good enough. Very good. Now you remember that whenever you talk about leases, every lease scenario has two angles to it. Every lease scenario has two angles to it. There is one side, there is right to use asset, and towards the other side, you have lease liability. For lease liability, you always work out dash. And what is this dash? Lease amortization schedule we make. Make sense? Lease amortization schedule. You have date column, rentals column, interest column, decrease in FLO column, and balance FLO column. These are the four columns that you make. Then you start from the very beginning. Always remember, the story always begins from the beginning. So the story began on 1st April 20x2. Yeah. And at that point in time, after down payment, our lease liability was 3.22 million. Make sense? It was 3.22 million. All right. Then what happens on 31st March X3? What happens on 31st March X3? Does anything happen on 31st March X3? Does anything happen on 31st March X3? The answer is no. Because the next rental, which is first, which is 525, is going to be paid on 1st April X3. And at that date, you will be paying a lease rental of, let me just revise it. You will be paying a lease rental of 525. Included in that lease rental will be some part of interest, and that should be 3.22 into 0.05, which is 161. And the balance obligation which you pay, the principal repayment that you make, is going to be 363. And here you go with your balance obligation 2859. Now, certainly there is no activity from the lease amortization schedule point of view. There is no activity on 31st March X3. But does that mean that we are not going to recognize anything? Do you all remember what do we used to specifically do whenever there was the case of advance lease rentals? Do you guys remember? I even wrote it down in your notes. What was the main thing whenever you saw advance lease rentals question? Yes, Hadia. Absolutely correct. You always have to accrue your interest. So you can see from here that 161,000 worth of interest is being paid on 1st April X3, which is one day after the year end, but still it pertains to the whole previous year we spent. And since it pertains to the whole previous year we spent, we need to accrue the interest during the year. So what we used to do was, we will write 31st March 20X3. We will be accruing our interest, and that means interest expense debit, interest debit with the value of 161. And thereafter, we'll be crediting accrued interest with the value of 161. Now, this is the accounting entry that you follow. Make sense? Make sense? So this interest expense is reported under your P&L. I can highlight this blue. This will be reported under your P&L. Under your liabilities, your balance sheet, you will be reporting first of all this accrued interest. This accrued interest, I will mark it orange. Yeah. Plus, you will also be reporting a lease liability equivalent to 3223, but that will be reported under two portions. 363 will be the current portion. I will write CP here. CP. And the other 2859 portion will be the lease liability portion, sorry, non-current portion. Make sense? And this is all what you report in your balance sheet. Is there anything else that we should do? Is there anything else? There will be depreciation on RUA. How do you calculate depreciation on RUA? 4373 is the value. You divide it by 5 years. 875 is the depreciation for the first year. Do you all agree? Now, please let me know. Is this difficult? I mean, you just have solved whatever was required, for the measurement of leases. You have just solved it. You just solved it. Is it difficult? I mean, students study, these kinds of things in their paper FR. And believe you me, these type of questions do come in SBR. Sir, they will not come in our attempt. Sir, they will not come in our attempt. God knows. But still, these type of questions, when they come, students are not very well literate about these stuff. I always say that IFRS 16, IFRS 15, IFRS 9, IAS 36, IFRS 13, IFRS 3. Now, these are the kind of accounting standards that examiner can examine any point in time. Especially IFRS 15 and 16, I always ask students to prepare very well. And IFRS 9, prepare very well. Because these are the kind of standards that are always repeated in examination. So you can never let these go. Rest of the accounting standards are obviously also important, but these are the accounting standards that are always tested. That are always tested. Make sense? Is everybody clear? I want your confirmation if everybody is clear. All good? Now, your question might be, sir, how to write an answer? Now, just before the class, I already wrote an answer just to save time. And whatever I discussed is totally in my own personal language, in my own plain English language. This has been written for you. I'll be providing you answers whenever you message me, or I'll be sharing it within the groups. But this is the simplest answer I could have written. And we can just go by it quickly. So I started my answer from writing according to, my aim was to explain IFRS 16 first. So I wrote it in a manner that every normal student would be writing it. I started it with IFRS 16, said that according to IFRS 16, a contract contains a lease if it provides the customer the right to control the use of an identified asset for a period of time in exchange for consideration. Then both of us know that what are the key terminologies here: the right to control, identified asset, period of use, and consideration. These are the four important things that you need to explain in your answer. I tried to explain it within by not consuming too much words. In IFRS 16, right to control is established when the customer has right to obtain substantial economic benefits from the asset, and the customer has the right to direct use of the asset. So I explained two further sub-requirements of the first requirement. The right to substantial economic benefits may be justified through direct or indirect cash flows, for example, subleases. Moreover, right to direct use is established when the customer can control how. If I were you, I would be highlighting this how and for what purpose the asset is being utilized. So I just mentioned what IFRS 16 says. Yeah. IFRS 16 further explains that in order for the lease to exist, there must be an identified asset. An asset is considered identified when it is explicitly mentioned in the contract and the supplier substitution rights are not substantive. If the supplier could replace the asset, again, without the reason of any major malfunction, then it will not be considered a lease. So I jot down the core points of IFRS 16. Maybe you can write some more, but these were the points that normally a student would be writing in their answers. Yeah. Then I shifted my answer, shifted my perspective towards the answer, towards a more explanation to the, with reference to the context scenario. I said that here, in this case, Jarid company has an explicitly identified device installed in the head office of Jarid company. The server is explicitly identified in the contract, and Servico cannot replace unless a malfunction. So it's an identified asset. Moreover, Jarid company has control over the operations of the server and can maintain it for software upgrades. This means that Jarid company has the right to substantial economic benefits. Servico does not have the right to modify the server or use it for another purpose during the concurrence of the contract, which means that Jarid company has full control over the how and what of the asset. Make sense? All of these conditions and circumstances suggest that this is a lease contract rather than a service contract. So I explained whatever was required to explain IFRS 16 and why do I see that this is a lease contract rather than a service contract. Then I discussed, something about measurement of leases. Whatever calculations that we did on the spreadsheet, I just explained them here along with the accounting entry. Now remember, this is necessary. This is necessary. So you can never walk back just by writing calculations. You will get 0 marks for it. The spreadsheet calculations that we did support your answer, but you always have to explain if the requirement says so. Yeah. So examiner said, explain with calculations. I did some calculations on spreadsheet. My examiner would be checking my markings. So I get full marks. I get relevant marks for it at the very least. And plus I include those workings within my answer here so that the situation becomes very easy for my examiner once he reads it. Make sense? So this is how you write an answer and it's done. I think if you were writing an answer on your own, this wouldn't have taken too much time. It's all controllable. All right. So now let's move on to the requirement number 2, requirement number B, which is the main requirement why we are doing this question now. So the first requirement is of 7 marks and then it will be followed by a 9 mark, another requirement. We'll discuss the B part 1 right now. It says discuss the reasons why cryptocurrency may not meet the definition of cash or cash equivalents or that of a financial asset, but may meet the definition of an intangible asset. So it's all about cryptocurrency in this question. So how many of you are actually aware what cryptocurrency actually is? And maybe if any one of you could simplify what cryptocurrency actually is, if you can simplify within few words, what is cryptocurrency? It's very important for you to understand digital assets. I explained the same thing in my technical article lecture as well. This is very important for you to understand. I have very high hopes that these digital assets, as a current issue or something else, will be tested as part of your question 3 when you go into the June 24 exam. I have very high hopes. So can you tell me what do you mean by cryptocurrency? Absolutely correct, Saeed. Absolutely. So, sir, it's a form of digital currency with no central contract. You won't call it central contract, or you can simply say it does not have a legal tender. So, in most of the jurisdictions, we understand that cryptocurrency, I always say currency, cryptocurrency does not have legal tender in most of the global jurisdictions. Yes, it's a form of, it's basically a technological evolution with regards to how we, of what we treat as a medium of exchange. Right now, you see, cash is basically a medium of exchange. You use it, you pay it to someone to buy something. So you are exchanging one hand from the other hand. Yeah. So digital currency is certainly a modern or a technologically evolved version of it. That's absolutely true. And the main thing is it is not controlled by a central bank. Largely, it is run based on the blockchain technology. And since that blockchain technology is transparent enough, its algorithm is solid enough that it has very less likelihood of being hijacked. That's why cryptocurrency mechanism does not require a central bank to regulate it. Yeah. So that's all agreed. It's a form of digital currency. Now, our point here is not to discuss if cryptocurrency or investing in cryptocurrency is good or bad. Our discussion point here is that whether cryptocurrency should meet the definition of cash or cash equivalents, or should it be recognized as a financial asset, or should it be recognized as an intangible asset? Can I do some voting with you guys? You have three options. As per the question, you have three options. Either you recognize cryptocurrency as normal currency, like the same way you follow IAS 7. So under IAS 7, cash and cash equivalents include all items that are less risky, their value does not significantly change, and items that are readily convertible into cash. So all items which are virtually cash and can be used as a medium of exchange are recognized under IAS 7. Then we have something like financial assets. Financial assets are recognized under IFRS 9. So either we can take cryptocurrency under IFRS 9 or we can take them to intangible asset. I want some voting. I want an answer from everyone. It does not matter whether you answer it right or wrong. You just need to think about it because that's the whole agenda of this question. Give me your vote whether if you would go with intangible asset or whether if you would go with IAS 7 or financial assets. And then we'll discuss in detail. Absolutely correct. So the point is that we all know in this point in time that cryptocurrency is best recognized as an intangible asset. And that means that it cannot be recognized as a cash or cash equivalent or a financial asset. And we'll do some discussion on this one by one. First of all, let us understand that why cryptocurrency cannot be identified as a cash and cash equivalent. You see, according to IAS 7, cash and cash equivalents are items which can legally be used as a medium of exchange. So they should have legal tender. These are items that are, that are of short life and they are readily convertible into cash and their value does not change significantly over time. So this is what IS 7 defines as cash and cash equivalents. But do you think that cryptocurrency falls within the same definition? For example, for starters, cryptocurrency in most of the jurisdictions does not have legal tender. So it's not authorized by law. So, for example, in Pakistan, where I live, in Pakistan, cryptocurrency is not legal. But rather, government has also announced that if anyone trades in cryptocurrency, they will pick that person up and put that person in jail, like we always do. So it's not only not it does not only have no legal tender, but it's a crime rather. In most of the jurisdictions, it's a crime to trade in cryptocurrency. Moreover, do you think cryptocurrency is readily convertible into cash? Or its value does not change significantly in the short run at the very least? Do you think the value of cryptocurrency is not exposed to significant change? That's not the case. The value of cryptocurrency always changes substantially within a short period of time. It always happens. Every now and then you go onto the social platforms. I don't trade in cryptocurrency due to my own personal religious reasons. But still, don't you hear every now and then that the crypto market is highly volatile? Highly volatile. Its value changes abruptly every now and then. So does it meet the thresholds of what IS 7 defines as cash and cash equivalents? The answer is no. Very good, Adya. Then we have another option. Either it could have been classified as a financial asset, but can cryptocurrency be classified as a financial asset? You see, what was financial asset? Let us just recall under IFRS 9 how a financial asset was defined. Either financial asset was cash, it was right to receive cash, it was right to receive other financial asset from another entity. It was equity instruments of another entity or potentially favorable contracts. These 5 things make up the definition of financial assets. Certainly, we just concluded that cryptocurrency is not cash. So that's out. Cryptocurrency is not an equity instrument. Whenever you buy cryptocurrency, all of us know that whenever you buy cryptocurrency, you not get the residual interest in the net assets of any entity. Cryptocurrency is supposed to be a medium of exchange. It does not replace what shares are. So it's not an equity instrument for sure. So sir, it can be a debt instrument maybe. Okay. In order for it to be a debt instrument, there must be a contractual right to receive cash. Do you think cryptocurrency provides a contractual right to receive cash? Do you really think that? Whenever you buy cryptocurrency, obviously you can convert your cryptocurrency into cash. You can just go and sell your cryptocurrency on the exchange. That's all possible. But do you have a contractual right to receive cash? So for example, you bought 1 Bitcoin or any fraction of 1 Bitcoin. So do you have the right to receive cash? I mean, it's all possible that the value of that Bitcoin goes zero one day or the other. You don't have a contractual right to receive cash. Yes, you will receive cash, but you don't have a contractual right to receive cash. I mean, its value can go zero anytime. Yeah. So it's certainly not a financial asset. Sometimes some sort of cryptocurrency can be a potentially favorable contract. It might fall into the definition of derivatives. Some products might fall into the value of derivatives, into the definition of derivatives. For example, if a coin is being used to offset a currency risk or some other cash flow risk, if it happens, it might be classified as a derivative someday or the other and be exposed to IFRS 9. But generally, can cryptocurrency balances be classified under the headings of financial asset? The answer is no. And then you talk about intangible assets, IS 38. So IS 38 defined intangible assets as non-monetary items identifiable non-monetary items without any physical substance. So clearly, cryptocurrency does not have any physical substance. It is intangible. I mean, that's the evolution part of technology. Had it been physically available, it would have been the same thing as normal cash. There would have been no evolution. So the evolution part, the digital part, certainly bring us towards the no physical substance part. Now we need to understand if it's identifiable and non-monetary as well. Is cryptocurrency identifiable? Is cryptocurrency identifiable? Identifiability basically means it can be separately sold or valued, separate to the other assets of the entity. Can you sell cryptocurrency separate to the other assets of the entity? Oh, yes. I mean, if one company, for example, Siemens buys cryptocurrency the other day, can they sell it without selling their other assets? Or can they value cryptocurrency excluding any other assets? Yes, you certainly can. Yeah. Are they identifiable? Yes. Are they non-monetary? Yes, they are non-monetary. We just discussed they are non-monetary. So the best accounting standard in which you can classify your cryptocurrency is IAS 38. Now you need to understand that there is no particular accounting standard for cryptocurrency published by IFRS, published by IASB till date. There is no one accounting standard. Entities need to work on a principal basis. And how do you work on a principal basis? We have discussions like these. We just discussed amongst ourselves that it's not feasible to classify it under IS7. It's not feasible to classify it under IFRS 9. So based on principles, where can it be best classified under the existing IFRS? It should be classified under IS 38. How should they be valued? IS 38 allows cost model and revaluation model both. What do you think, Saeed? Which type of model would be best suitable for cryptocurrency, cost model or revaluation model? Which model would be best? I mean, it's an accounting policy for the entity, but still for the sake of asking, I'm just asking which model would be better. Certainly you guys are very smart. Certainly you follow revaluation model because cryptocurrency, is the value of cryptocurrency is highly volatile. And you would want that volatility to be reported in your financial statements, because it's your investors' money that you have further invested in cryptocurrency. So you want to reflect the same volatility within your financial statement so that your investors are aware with timeliness. So you go with revaluation model. But while you're going for revaluation model, always remember that IS 38 provides for this fact that revaluation model should only be used when there is an active market for an asset. If there is no active market, you are not allowed to opt for revaluation model. It makes sense. If there is no active market, where are you going to get the fair value from? But, and there is a question. Abdurrahman, do you think that cryptocurrency has an active market? Do you think? Yes, absolutely. Cryptocurrency has an active market. They are 24/7. They are traded on exchanges. Make sense? So, this is how you conclude on an answer. You conclude on an answer, whatever we have discussed. And I'm so glad that you guys are so smart, mashallah, that, you can answer my points relatively clearly. But sir, how do we write it? You write it like I did. Yeah. So I'll just read the answer with you guys so that you understand. And if there is any point that you don't understand, you can ask me right now. So basically, cryptocurrency is a technological evolution which aims to transform the existing medium of exchange. No particular accounting standard defines the accounting for cryptocurrency, and that is why entities have to take principal stance as to how to account for cryptocurrency balances in their financial statements. Number one, we discussed the requirements of cash and cash equivalents. According to IS 7, only items such as cash, which are legally recognized, and equivalent items like demand deposits, etc., which are readily convertible into cash, should be treated as cash and cash equivalents. Accordingly, the major issue in recognizing cryptocurrency as cash is that it does not have legal tender in majority of the jurisdictions. Some companies do accept payments through crypto, but they are not legally required to do so. So there is no legality of cryptocurrency, and that is why they can never be used as a medium of exchange and be recognized under IS 7. Hence, it does not generally act as a medium of exchange. Furthermore, like normal cash, cryptocurrency does not have a short term life. Their value is exposed to massive short term changes and has a risk. Therefore, at present, it cannot be termed as cash or equivalent. Why did I write at present it cannot be termed as cash? Why did I write at present? Why? Because guys, in future it might have legal tender. My lecture might get obsolete, few years after. That's all possible. When it does, we might see a new accounting standard. Yeah. Financial assets. Certainly, cryptocurrency cannot be termed as an equity instrument as it does not provide residual interest in the net assets of the entity. Moreover, for crypto to be recognized as a debt instrument, there should have been a contractual right to receive cash. Cryptocurrency does not provide any such rights to receipt of cash. Therefore, they are not debt instruments either. However, some of their products may be termed as derivatives, as the case may be. Then I define what IS 38 actually says. This is absolutely the same thing as we discussed. Now that's done. I did not even open the exhibit number 2 because the part 1 of B did not require me to open exhibit number 2. There is no need to refer to a specific exhibit to answer part B. There is no need for exhibit number 2 to answer part B, part 1. Excuse me. If I move on, I have another 9-mark requirement. And it says that using exhibit number 2, discuss the steps that Jarid company should take to measure the fair value of the cryptocurrency in accordance with IFRS 13 fair value measurement at 31st March 20x3. You need to briefly explain the impact of fair value measurement on Jarid company's financial statements. And for 9 marks, a pure IFRS 13 requirement has come. Can we quickly revise IFRS 13? I hope it helps you. So IFRS 13 basically defined fair value as the price that would be received to sell an asset or transfer a liability in an orderly transaction between market participants at the measurement date. So basically, IFRS 13 refers fair value as the exit price. Yeah, whatever price you would have to pay to sell an asset, not to buy an asset, but to sell an asset or to transfer a liability. It's an exit price that you use as fair value. Remember, IFRS 13 always said that whenever you are determining fair value, that should be determined from market perspective and not from entity's perspective. And since fair value always have to be determined from market's perspective, you need to know what a market really is. So a market is basically, whenever you're determining fair value, IFRS 13 provides for this fact that entity should refer to dash. Can anybody tell me entity should refer to dash what? Dash what? What was the first thing that we have to refer under IFRS 13? Principal market, absolutely. Principal market. What do you mean by principal market? Principal market is a market which has the most number of transactions for the asset, where most transactions takes place. And in the absence of any principal market, you can go for most advantageous market. Most advantageous market is defined as the market which is determined as selling price minus transaction cost minus transportation cost. You subtract everything and then you get the most advantageous market. And then we learned under IFRS 13 how non-financial assets are to be measured. There were 3 hierarchies, through which you determine your fair value, level 1, level 2, level 3, and so on and so forth. Remember? So, a very, 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 very short and quick revision of IFRS 13. I hope this helps while we read exhibit number 2. Let's go on to read exhibit number 2. All righty, guys. Let's see. The directors of Jarid company, let me just move it a bit. It says that the directors of Jared Company believe that the measurement guidance in IFRS accounting standards does not provide relevant advice on cryptocurrency valuation to help them prepare the financial statements. Is Jared Company true in this regard? Existing IFRS do not clearly define how to account for cryptocurrencies. There is no clear accounting standard for it, right? It says that after consulting the external auditors, the directors of Jared Company intend to account for the company's cryptocurrency holding using the cryptocurrency holding using the revaluation model under ICE 38 because the auditors do not believe that cryptocurrency meets the definition of cash or cash equivalents or that of a financial asset. You need to understand from a reality perspective as well. Luckily I have been into many conversations with auditors, where we enter into a certain kind of transactions for which there is no clarity how to apply an accounting standard or whether even an accounting standard exists or not. Entities often refer to their external auditors while they are making a decision with regards to the following of a particular accounting standard, because this happens. I'm telling you, this happens all my real life. I've seen that there are certain transactions for which you are not clear how to account for these transactions. Now, before entities make their final decision, they always refer it to their accounting, their external auditors. At least some of them refer to their external auditors, so that they take their opinion whether if they are going to accept financial statements as is or not. Because there is no point implementing a particular accounting standard at the start of the year, and towards the year end, when your external auditors come to you, they say, we won't accept it. This is not as per accounting guidelines. If that happens, all your systems, all your controls that you built up around that treatment, then that all will go in vain. So external auditor's opinion sometimes is important. So examiner says on 1st of January 2023, which is 3 months before the year end, Jared Company purchased 1,000 units of a cryptocurrency for 6,500 per unit. So 6,500 per unit was the price. 6,500 per unit was the price you bought each unit of a cryptocurrency. Isn't this very cheap? I mean, in total, we just spent $6.5 million. Just imagine. You buy one unit of a cryptocurrency for $6,500. You don't pay my fee and say that some are so expensive. And this Jared company bought 6,500. They paid $6,500 per unit of something which does not even have legal tender. You can say my classes are not so expensive after all. It says the cryptocurrency is traded in several markets with different prices being quoted in each market, as there is no single price for cryptocurrency. Okay. Jared company cannot access every market. Please, please, please. This is a very important point for you to understand. Jared company cannot access every market. Give me an idea. If we cannot access a particular market, can we take that market's price as fair value for ourselves? Would it be the principal market or the most advantageous market for us? I mean, it's not relevant. Any market is a market if it's freely accessible. If it's not accessible due to government restrictions or something like that, it's not a market. It's not a market that you refer to determine your fair value. Make sense? So, that market needs to be freely accessible. Jared company cannot have access to every market, as some markets have restrictions which affects the trading of cryptocurrency. So any market which have restrictions towards the trading of cryptocurrency, it can never be a benchmark for you. The markets are volatile, but trade 24 hours a day. So it's, the value of your cryptocurrency can go up or down any point in time. So here your examiner is basically providing you some data with regards to markets and their sizes. Please refer them out. Examiner says there are 5 markets in total. Examiner discusses the market size, dollar million, transactions per day, price per unit, and the restrictions that are applicable. We'll just see what data we have. So the first market that we refer to is market number A. The market size is just $45 million. Transactions per day are 1,500. Price per unit of the cryptocurrency that you have bought is 6,700. And it allows trading for values less than $10,000. Can we benchmark A for our own fair value measurement? Can we benchmark A? A is a very good market. It has worth of $45 million. Transactions are 1,500 per day. It has good price of cryptocurrency. But you see, it only allows transactions that are worth $10,000 and below. How much did we invest in cryptocurrency? How much did we invest? We invested $6.5 million. Would we ever refer to this market A? If we have invested $6.5 million, we are not allowed to trade $10,000 or more. For us, A is not relevant. B, the market size is now $200 million, which is quite a lot. 10,000 transactions per day. The price is even higher than the previous market, 6,800. And here, trading in cryptocurrency needs a license which can only be obtained by financial institutions. Now, it was not written that Jarid company is a financial institution. Can we refer market B? Give me an idea. Can we refer market B? I mean, it's not freely accessible for us because we don't have the license. And that license can only be obtained by, banks. We're not a bank. C, the market size is 4,000 million, 4 billion. Transactions per day are even higher than the previous one, 250,000 transactions. Price per unit is 6,300. Trading in the cryptocurrency is on the derivatives market and is not subject to specific regulation. Can we consider market C for our fair value measurement? The transactions are good. Remember, principal market is the market where most transactions take place. More transactions takes place. So this is a very huge market as compared to others. The price is okay and there are no restrictions. Can we refer to C? Yes, maybe we can refer to C. So what about D? The market size is 4250, which is very much similar to market C. Yeah, so there is not much difference between the values of C or the values of D. Transactions per day are 275,000. Again, very much similar to what were happening for C. The price is 6,350. Trading in the cryptocurrencies on the derivatives market and it's not subject to any specific regulation. Again, it's a free market. So D is also relevant. E, $560 million, 3,500 transactions, very less, even less than B. 7,560 value, excellent. Although there is no direct ban on the trading of the cryptocurrency, there are very strict rules which makes trading in cryptocurrency a difficult process. Can we consider market E for us? No. I mean, if you have balances of cryptocurrency, how will you be able to access market E and sell your balances if trading is very difficult? You won't go there. You won't go there. So logically speaking, the only two relevant markets that I see are market C or market B. Now, how do you decide which market is actually going to be used for fair value measurement? The first criteria was principal market. Now, the principal market is defined as a market which has the most number of transactions. Now, I would recommend that you don't fall for this trap. You would say D. Everybody is saying D. But the point is, you see, Hadia, there is a context to it. Although you are not wrong, Hadia says that, sir, D has the most number of transactions and therefore this should be the principal market. You're right. But At the very least, you should try and think about it. There is not much difference between C or D. I mean, one market has 275,000 transactions per day. It has 250,000. The other day, C market could also have 275,000, transactions per day, or B could fall to 250,000. There is not much difference. You see, let's say there are two food stalls in a shopping mall. It is possible that on a particular day, you see too much rush on a particular food stall. But is it not possible that the other day that rush is on stall number 2? It is possible now. So in this particular case, although mathematically you are right, but technically speaking, there is not much difference between 250 and 275,000. There is not much difference between 4 million market valuation versus 4.25% market valuation, and rest of the things are same. The market is technically same. So for me, it's difficult to identify principal market. Although you may have answered ND, and if you would have explained it correctly, you would have got full marks. No worries. But from a more substantive point of view, a more commercial point of view, it's not easy to identify what is the principal market, even though their prices are similar. If their prices are similar, now then you need to determine that what is the most advantageous market. What is the most advantageous market? So just think about it. Are there any, transaction cost or transportation costs given? If there are no transaction or transportation costs given, I think this is the net price that you get. This is the net price that you get. So maybe based on most advantageous market, you are better able to conclude that market number D is the relevant market. You understand what I'm trying to say? It was difficult to identify the principal market because both of the markets were very similar to each other. The other thing could have been that you go towards the most advantageous market. If you refer to the most advantageous market scenario, then you go to D, it's more relevant because there is no way out now. There is no way out now. Definitely market number D is the most advantageous market for you now. And the 6350 per unit price you should be referring to. Make sense? What will be the implication on financial statements if anybody could say? You see, we bought each cryptocurrency unit for 6,500. Now that 6,500 unit is 6,350. That means per unit we get a loss of 150. And in total we have 1,000 units in our pocket. So that means 150,000 loss. Can anybody tell me what would be the accounting entry to recognize this loss? Because we are carrying these cryptocurrency balances under IS 38. Can anybody tell me how do we account for this 150,000 loss? How do we do that? What's the accounting entry? Certainly your intangible asset goes credit. What do you debit? We were following the revaluation model. But even under the revaluation model, my friends, any downward valuation or devaluation, what you call, is written off under P&L. So P&L debit, intangible asset credit. This is the correct accounting entry that you follow. Make sense? All right. So how do you write an answer? It's written. I explained each and everything. Sir, will you provide us this answer? Oh, yes, obviously. Why else would I be writing it? I've just written it before the class so that I could save time and we could have more, more verbal discussions. I want to clarify your understanding because me writing an answer doesn't help you. You writing an answer for your own self helps you. Make sense? Make sense? Please let me know if everything is clear for you guys because this question is complete. This question is complete.